Hi folks, yeah, you're all very welcome to this afternoon's market update. We'll just give it a few minutes here, a few seconds, just while people are coming in. There's just a bit of a queue of people coming in, so just give it a few seconds before we kick off. Yeah, numbers seem to be filling up there. So, so look, you're all very welcome to the latest market update. A bit of a change from our usual quarterly update, but given recent events in Russia and Ukraine, we felt maybe just a bit beneficial to provide you with a quick update, give you some of the talking points that we're discussing inside here in Davy, and to help answer some of your questions. So, provide the update today. We have Gary Connolly, who's head of advisory and execution only in Davy, and myself, Declan King, head of investments in Davy Select. So, look, ultimately, the purpose of this call is to try and provide some read-through into financial markets with what is a desperate situation in Ukraine, whilst recognising that the wealth effects and the performance of markets do impact us and impact our clients. They do seem of little importance against the humanitarian impact of this crisis. So today we're going to cover a few points, but more importantly, there is a question box at the bottom. So please do send through your questions. I'm sure other people will be interested in what your questions are. Other people will be also interested in the answers to those. So please do send through some questions. But look, we're going to focus today on financial impact so far from the conflict, the outlook for inflation and interest rates going forward, given these were the main two talking points from the last few weeks and from our last webinar back in January, and what we should be watching out for coming forward, along with how should this affect decision making and help affect your own decision making. So before I hand over to Gary to have a look at the financial impact and the kind of broader impact so far, I just wanted to kind of set the scene in terms of market numbers and what markets have been doing so far this year. So in terms of the various different indexes, the FTSE probably the best performing so far this year, slightly positive, with a lot of the other bigger indexes out there in negative territory. Emerging markets not doing too badly, down just over 2%. MSCI World down over 7%, S&P 500 down over 7%, and the MSCI All Country Europe down over 9.5%. So again, a bit of a bounce back from what we saw last Thursday when the markets kind of bottomed out at that stage, but we have seen a bit of a recovery since then. In terms of currencies, we've seen a bit of a flight to the dollar and to the yen, both up over 2% against the euro, and we've seen sterling up over 0.6% against the euro. But the big movers really has been in the commodity space. Oil up nearly 40%, depending on what you look at in terms of Brent crude up, in terms of performance up nearly 40%. If you're looking at other ones that are kind of important in this crisis, palladium up over 35%, and then into the soft commodity space with the S&P all wheat index up over 28%, and the S&P corn spot up over 24%. So that's a bit of a new one in terms of what we've all been monitoring over the last while. But in terms of what does all this mean, I'll hand you over to Gary there now, and we'll get this started.
Thanks, Tech. Look, it's obviously a developing situation. Things are quite volatile. And apologies, it's often easier to speak to a chart. So for those of you that are more visually inclined, and I include myself amongst you, we unfortunately don't have any charts. As you know, to put the session on a short notice, it's just not possible to get things signed off in time. So I'll do my best to describe the scenarios verbally. I suppose, Thursday and Friday, to my mind, were extremely strange days. Markets had snapped back after a fairly grim start to the week, and I suppose that really followed the market digestion that the initial round of sanctions were very minimal, and then it was only on Monday that the slightly belated international sanctions began to bite. So the pain that they had inflicted or have inflicted on Russia, its economy and financial system, was fairly immediate. I mean, the central bank main target interest rate there has doubled, or in fact more than doubled, on Monday to 20%. And a desperate move like that shows that sanctions are now much more than symbolic. You'll have seen on Twitter and various other places images of people queuing at banks and ATMs. I mean, we've some insight to that, obviously, from the the 08 crisis, and the impact on corporate Russia then on its financial system. If you look at things like Sberbank, which is by far the country's biggest bank, listed in London since 2011, its stock just completely collapsed. The most liquid traded Russian bond is trading at 35 cents in the dollar. Well, as of yesterday, at least, it was trading at 35 cents in the dollar. And Russia could default on its bonds because of an inability to make payments to investors again. I mean, whatever about desire to pay, just through the financial sanctions and being cut out of the SWIFT payment system, just may have to default on payments on that bond. And what's like real yields? So what's been going? So real yields which had been rising so far this year. So real yields are yields on inflation protected bonds. So essentially, they're measuring the difference between nominal bond yields and inflation. And the events of the last week have essentially cancelled out roughly half of the increase in yields that have happened so far this year. And like that in turn, to some extent, explains why the damaged equities has been relatively muted so far. I mean, I say relatively muted, recognizing that look, markets are down in a lot of cases 10% so far this year, but steeply negative real yields make it much easier to buy stocks. So my sense is that has been a prop under markets to date. When you look at commodities, and Declan's giving you some of the numbers there, there was hopes that commodity prices had put in near a high near the end of last year. Those hopes now seem to be decisively dashed. At the same time, like the point at which raw material prices begin to take headline inflation rates lower seems to have moved further into the future. I mean, we still think, I think most forecasts still call for a peak in inflation sometime in the next few months, but I think the conflict or the war looks as though it will delay that peak. I suppose the major sanction announced over the weekend was the freezing of central bank assets. The still missing bit is restricting Russian gas to Western Europe, which are excluded from sanctions. So Russia essentially can keep going for quite a while on I mean, the hard currency it gets from gas exports, even if its central bank assets are frozen. So to that extent, that shoots a bit of a hole in the sanctions package. However, what it does do, I suppose, and this has been kind of called out in the Financial Times, it does deter Russia from potentially switching gas off to blackmail Europe, in case it essentially bankrupts itself. Now, recognize, look, Europe isn't its only market. There is India, there is China, but still, it should act as a deterrent. I suppose the crucial point is that what it highlights about Russian bank reserves and reserve accumulation is that other oil gas producers like, say, Norway and Saudi Arabia, that's a source of funding to Western markets, as is Russian reserves. So reserves don't simply sit idly in central bank accounts; they're lent out. So if you sanction Russia, you block hundreds of billions of dollars in global balance sheets, and you have to ask, well, what happens to the other side of that balance sheet? Because reserves for Russia, I mean, they're Russian assets, and they're somebody else's liability. So who in turn has balanced that liability with an asset and so on? So those chains are a little bit complicated, but what it does, I suppose, highlight is that it does have implications for liquidity. So notwithstanding the fact, and you probably have numbers on it, but notwithstanding the fact that Russia and Ukraine are small in terms of a global kind of footprint, it does have implications for liquidity in markets. So when we get moves in markets that on the face of it don't seem to make a lot of sense from a fundamental standpoint, that's often the case when you get dislocation in markets, and that can be a good thing, obviously. So when things trade away from fundamentals, that's when people obviously make money. So it can be a good thing, but from a psychology point of view, can be a little bit disturbing.
Yeah, I think that was a lot of the narrative last Thursday that was kind of coming out around, there was kind of a realization, especially in the US, that if the US don't particularly want to get involved in this, and the less they kind of seemed that they were going to get involved from a defensive point of view initially, markets kind of realized that maybe Russia and Ukraine are not that big a heavyweight when it comes to global markets, and probably that's one of the reasons it rebounded. But just want to kind of drag it forward a little bit to what we discussed really in the last market update, and what's really been on everyone's mind kind of since the middle of last year, which is inflation and interest rates, and what this has, what will this impact inflation. So some of the numbers that we're hearing in terms of headlines, and that kind of we're getting questions on, is 50% of Russian exports are made up out of oil and gas. Over 10% of world oil comes from Russia, second largest gas provider in the world, and probably closer to home, 40% of European imports of gas come from Russia. So obviously that's the reason why we're starting to see big fluctuations in the oil price. It is worth noting, I suppose, in Europe, we have become less vulnerable, I suppose, it seems, to Russia and natural gas, in terms of we have seen a reduction in natural gas in the last couple of years, or particularly last year, when we're starting to see a bit more of an energy transition. I think imports were down 42% year on year in Q4 last year. So again, if this had happened maybe a few years further down the road, it probably would be less important. But the other one that's kind of potentially, which I'd like to get your opinion on in terms of inflation, is around the soft commodities then. So Ukraine, known as the breadbasket, which I wouldn't have heard before, but I've heard that term used a bit based on the amount of wheat they produce, but also the type of wheat they produce. So we're likely to see, where we have seen, significant increase in prices there. Just to give some numbers around it, 12% of global wheat comes from Ukraine, 16% of corn, 18% of barley, and 19% of rapeseed all come from Ukraine. So again, likely to see, and we have seen an increase in the price of these. But I suppose, what's that likely to do to inflation? Last year was all the term transitory was used all the time. Are we likely to see inflation around for a longer period? High inflation now, do you think?
Yeah, I think transitory as a term as probably is past use. Probably Federal Reserve probably regrets ever using the term. But you're right, like, inflation was the only story in markets prior to this. That obviously hasn't gone away. I mean, I suppose when you look at it, I mean, there is an aspect of inflation which is an artifact of using a pandemic baseline, whereby the past year comparisons should support a reduction in headline inflation rates. In particular, things like used car, fuel, and gas. And now I say gas prices, in terms of US inflation. Gas prices in Europe and US dance to very different tunes, and they're actually at very different levels. But certainly in terms of the US, we should see that baseline effect and inflation numbers coming down. Also worth noting then that some of the things that have experienced the highest rates of inflation over the past year or so are some of the same things that have tended to experience less persistence in price movement over the past decade. So that said, there's it's not purely a product of pandemic related factors. There are price pressures. There are some which are becoming a little bit more deeply rooted. The Atlanta Fed has this thing called a sticky CPI index, which focuses on prices that don't change very often. And that's at 4.2% year over year in January, up from 3.7%. Services inflation, which is not subject to the same pandemic effects as goods inflation, is at 4%. And then average hourly earnings growth rose to 5.7% in January. That's the number, I think, which probably keeps the Fed up at night, in terms of the potential for a wage price spiral. So the Fed's balancing act in terms of, on the one hand, promoting price stability, and the other growth, has gotten undoubtedly harder. But if we look, what are I suppose the positives are, the widespread lifting of COVID-19 related restrictions should ease supply chain backlogs. I mean, there's definitely data coming out, and PMI surveys are suggesting that inventories are growing and supplier delay times are decreasing. The shift in consumption patterns. So a lot of this talk about, well, part of the inflation was a shift in consumption from when we couldn't consume goods during the pandemic to consuming services, or sorry, other way around, consuming services to consuming goods. So that shift in consumption patterns away from goods towards services should help reduce inflation. Although service inflation, given the tight labour market conditions, is obviously a cause for concern. I suppose the most crucial data to watch to confirm or else challenge that view is wage growth, service inflation, and the cost of shelter. Because I think, and obviously China's zero tolerance policy on COVID-19 doesn't help either, because there could be, in terms of that easing of supply chain restrictions, there could be a sudden closure to factories in key exporting regions in China. The one other thing is, like, the social security recipients in the US are about to receive a so-called it's cost of living adjustment, so a COLA increase they call it. So that's going to be 5.9% this year. That compares to a 10-year average of 1.6. So that's an extraordinary increase. So there's definitely there's definitely a case for thinking that inflation is definitely going to fall back, but just not back to levels that we've been used to for the last kind of generation. Now, what that level is, I don't know, but so it's still a topic of debate. It's a very good guy in the FT, actually, Martin Sandbu, who makes a very good case that the current phase is much more of an artifact of the pandemic, and it should ease. Then you have others, obviously, on the other side of that debate. I suppose the read through here, I mean, it's not, obviously inflation is clearly important. The read through then to interest rates. Interest rates. Certainly traders or investors seem to have dialed back much of what they expect the Fed to do. So the Fed, in terms of lifting US interest rates, central bank attempts, in obviously to curb inflation. So money markets had earlier this month been tipping the Fed to raise rates to roughly 1.7% by the end of the year. By Monday, by the end of Monday, those bets had dropped back to 1.4%. So markets are clearly projecting that rate increases are not going to be as hawkish as they once were. The peak rate of interest then in the US is, which I think is a little bit extraordinary, is projected at 2% in the middle of next year. And the market seems to be happy to think that that's consistent with an inflation rate that averages about 2.5% over the medium to long term. So you can look at, there's this five-year inflation forward, which gives you an indication what the market anticipates inflation to be in the 5 years from, not the next 5 years, but in the 5 years. So what are we, 2027 essentially to 2032. And that's projected at, so the market thinks that the Fed has things under control at 2.5%. So if the peak interest rate is 2%, then that's projecting a negative real interest rate of minus 0.5%. That's still very accommodative policy by any standards. I suppose in Europe over the last 2 weeks, the market has gone from anticipating rates pushing almost to positive territory to predicting now that they're not going to move at all. So that's a fairly significant move in Europe relative to the US.
Yeah, I think that was even interesting. It was a similar feel to when during COVID times last year, when we got some bad news on COVID numbers, the likelihood of more monetary policy was kind of floated around and markets actually kind of bounced, and especially kind of growth assets. We kind of saw a little bit of that, I thought, in the last few days as well, when, some sentiment around interest rates not being increased. We saw some growth assets kind of coming back a little bit towards the end of last week, or more so the start of this week again, which is an interesting the kind of a dynamic when negative news is kind of inversely kind of positive for certain sectors of the market. So it was look, it's an interesting one on a daily basis. Every day is different news really in terms of at the moment. So just in terms of what we're watching out for, you touched on the increased sanctions this week, and it seems like there's more news on sanctions and the severity and their impact. I was on an interesting webinar last week where they had a sanctions expert, and he explained that sometimes actually sanctions are more effective as a threat really, but once they're enforced, it can kind of cause, you need to keep increasing sanctions once you cause, and that does seem like that's what's happening at the moment. We've also kind of heard lots of, you mentioned it earlier, around Russia being described as a fortress now, and being able to deal with certain levels of sanctions, and maybe even able to deal with them for a specific length of time that they can withstand it. So in terms of all of that, what are we looking out for, you think, in the next few days and weeks ahead?
Well, lots of things. I think, as you point out, in terms of Russia's energy sector, whatever, like it's 20% of Russian GDP, 40% of fiscal revenues. I think Europe would suffer profound consequences if there was a disruption. Given its reliance on, notwithstanding the fact that as you say, that reliance has curtailed somewhat, but it's significant reliance on oil and gas and other commodities for its manufacturing sector. I suppose extreme risk case, which we would probably define as one that has a lasting material negative impact on global growth, is that if the conflict escalates to a level that it pushes Western nations to accept disruption to those energy flows. So sanctions on energy, I think, would change the calculus quite a lot. We don't think the West has a whole lot of appetite for that. The West being say in the US. So Biden has midterm elections coming up. He has sliding approval ratings. There's nothing like signs on the forecourts of petrol petrol outlets. To entrench in people's minds about rising inflation, rising price levels. So I don't think there's a huge appetite for that. Energy prices, I mean, energy prices clearly a key factor to watch. I mean, if oil prices were to rise to $125 a barrel, say over 2 quarters, the estimates are that would take roughly half a percentage point off global GDP. And obviously impact inflation as well. A prolonged move then in oil prices above 125 would make us, obviously much more cautious. If Russia's energy flow was disrupted, clearly that means higher risk premiums and lower global growth or global earnings estimate, and that would likely trigger more lasting losses for equities. So look, these are all things that we can probably envisage. They're parts of scenarios that you can map out and attach probabilities to. I suppose the subtlest threat is of dislocations that we can't foresee. I always like the example, I don't know, you read Morgan Housel as well, but the Lehman example he uses, where Lehman, it was in great shape on the 10th of September 2008, Tier 1 capital ratio at just under 12%, which was higher than Bank of America, higher than Goldman Sachs. It was higher than it had been in 2007, when arguably it was, the banking sector was at its strongest point. And then 72 hours later, it went bankrupt. And the only thing that changed during those 3 days was investors' faith in the company. So one day they believed in the company, and the next they didn't. So that faith is that's the only thing that mattered, but it was the only thing that was hard to quantify or hard to model or hard to predict. And you can't compute, it doesn't fit into kind of traditional valuation models. So I suppose we need to approach this with a sense of humility that, look, wartime means pricing in more unknown unknowns, essentially. So there's things we know and can think about, and then there are those that we just can't. I suppose there's a very good interview I read rather, in Politico magazine with a lady called Fiona Hill, who's written a biography on Putin. And what she was saying is that Putin, doesn't necessarily want to occupy the whole country, but really to divide it up. And he's looked at things like Afghanistan and Libya and Iraq and other places where there's a division of the country between officially sanctioned forces on the one hand, and then rebel forces on the other. And that's something that, in her view, Putin could definitely live with, and kind of fractured, shattered Ukraine, and with different bits being in different statuses. I suppose I didn't get a whole lot of comfort, to be honest, from reading the article, but it just did give me a better sense of what's going on. So I think in terms of risks and things to be that would lead us to be more cautious. I suppose our views that, look, longer term inflation expectations, if they begin to rise, if that's a sign that markets are starting to worry that the projected interest rate path could be insufficient to manage inflationary pressures, that the Fed might have little choice but to hike rates more aggressively. The so-called Fed mistake, but the alternative is that risk, or is the risk that longer-term inflation expectations stay contained, but they only do so because the market thinks that the Fed is driving the economy into a recession with overly tight policy. The shape of the yield curve will give us an indication there. So if we do see short-term interest rates meaningfully above long-term rates, that would indicate that the market fears a recession is ahead. That spread currently between 2-year and 10-year yields is about 40 basis points. It's narrow, still in positive territory, but it is quite narrow. So lots to be thinking about on all of those fronts.
Yeah, like to talk about the risks, like I think last Thursday was one of the more interesting days. Don't normally watch Bloomberg TV, or even though when we're often in the office, someone has it blaring on the newsworthy days. But I did sit down that morning, obviously trying to get any kind of news. And, as markets were tumbling and, we were down over 10% on a year-to-date basis, they kept putting up a chart, very similar actually tables that we sent out on Friday around performance after geopolitical events. And I think, it seemed like, there was a general mood out there that the markets were selling off and it became a bit of a buying opportunity, it seemed. And markets on Thursday ended up in positive territory. So on the day, effectively, that this all really went into motion, markets in the US in particular ended up in positive territory, which, if you had a crystal ball on Wednesday and you knew what was going to happen, I don't think you'd have invested correctly. So even when the funny thing about markets is that even if you do know what's going to happen, it doesn't necessarily mean you'll get the call right from an investment point of view. So the other big kind of thing was that everyone is saying, it's not the first geopolitical event ever, obviously, and it's not even the first time Russia have invaded Ukraine, but people are saying this time it's different because of economics, the economic landscape we're in now, because of different political scenarios around the place. Is this in any way different? And I suppose what are the implications for investment decision making going forward? We have a question in here at the moment as well, which kind of links into this, saying, is it an opportunity to de-risk portfolios, or is it an opportunity to invest cash at the moment? So in your view, the easy question of what are the implications of all of this for investment decision making?
Yeah, well, I think it's right. You can't, I don't think you can generalize. Obviously each situation is different, but it is worth noting, though, that events linked to geopolitical turmoil have historically tended to be short-lived. And in my experience of these events, the greatest risk to investors comes more from behavior like panic selling or under diversifying, rather than the financial market events themselves. Now, that said, I mean, it's very unusual for stock markets to sell off aggressively outside of a recession. So if you look back, the bear market that happened around Black Monday in 1987, which was the worst day in US stock market history, that's the only example since the 1960s of the S&P 500 falling more than 20% without a recession to follow it. So it seems like we markets really only cough up a lot of return during or just before a recession. Now, recessionary risks in Europe certainly have risen dramatically in the last fortnight, but I don't think there's anybody calling for a recession in the US or globally right now. Things obviously can change; it's very fluid. But European bank stocks are taking a bit of a pummeling at the moment, which looks a little bit ominous. And mention of stagflation has certainly increased. But I suppose history tells us that the wonders of working at home on a Ring doorbell, history tells us the Fed tightening often eventually leads to a recession, but it also tells us that markets continue to rally after the Fed starts tightening. So since the early 80s, in the 6 months that have followed the first Fed rate hike cycle, the S&P is on average up 5.3%. So there is some succor in that, I suppose. On valuations, I suppose with bond yields rising, equities, they look less attractive in relative terms, but the yield gap, so if you look at the inverse of the PE ratio, less the 10-year bond yield, that's still above its long-term average of at 3.6 versus say just over 3. So that suggests equities will likely outperform bonds. That might be cold comfort, given that they've always outperformed bonds, but is what it is. And I suppose it's difficult not to sound, when you're talking about what are the investment implications of it's difficult not to sound cliched or trite when you're talking about taking a long-term approach and looking through the volatility. But I think advisors are well aware of this stuff, and I've even seen notes and updates from a few financial advisors this week advocating just that. And I think it's right. We can't be too definitive here as to, there's so many moving parts. There's actually a guy who writes in the FT called Robert Armstrong. Some of you might read his stuff. So he wrote a column about 2 weeks ago, which I read on Russia, and he was and he wrote a mea culpa yesterday on how we got Russia wrong, because he was essentially advocating buying stocks in Russia a couple of weeks ago. And so he wrote a mea culpa, and I think it's really interesting the way, if I just get his, 1 second, I'll just read you the part of the column. So he says, just, like, he's trying to dissect how we got it wrong, and he says, I think part of my problem and a lot of other people's was which experts we talked to. All the people I spoke to were strategists and portfolio managers who've been following Russia and Russian stocks for a long time. But when we were thinking about risk, it's dangerous to depend only on those sorts of insiders. The lesson when drawing or doing a hard analysis or risk assessment include both seasoned pros and people who bring fresh perspectives and don't make the standard assumptions. I mean, he won't be the last person to call it wrong, I suppose, but the lesson I take from it is not to be too definitive in the face of such uncertainty. If you're investing in equities, there is uncertainty. I mean, that's why that's why there's an equity premium. That's why it has been so large, at least historically. So if you're in the game, that's the price you'll have to pay. I mean, if you're with the options here, if you're fully invested, there's no need to do anything. If the situation does deteriorate and we get a significant sell-off, I just speaking from a Davy investment team point of view, we're likely to increase equity allocations. If you're an investor, you're sitting on the sidelines or you're holding excess cash, I think now is a time to consider making an investment decision and maybe phase in. I mean, the bottom is only ever going to be obvious in hindsight. So I think using the weakness in markets to build a position that is long-term appropriate makes sense. Because if you wait around, make the decision or decide what's appropriate for you in the long term, and just using weakness in markets to build that position, I think is appropriate. Because ultimately, who knows? I mean, the best we can do is just try and tilt the odds in our favor. When the market is offering us favorable odds, as in when returns look better than average, we need to be, you need to be brave. Likewise, when markets aren't offering those odds or favorable odds, we should have some dry powder, I suppose, for the periods, and wait till the pendulum swings in the opposite direction. So all of this obviously a lot easier to say than do, but so that's what I'd say. I don't know, does that answer? What was the actual question? Does that answer?
Yeah, it does. Yeah, it's around the opportunity at the moment, or is it an opportunity to de-risk, or is it an opportunity to invest in cash? So look, I think it's I think you did as good a job as you can. I think one of the narratives of this chat that we're having here is that we don't really know. The idea was to provide a summary as best we can for what's going on at the moment. So with that in mind, I think we said we'd be brief. We said we'd keep it less than half an hour. We've gone a little bit over, but just want to thank you again, Gary, for coming on today and giving us your insights there. And particularly thank everyone for attending. Great attendance at this, which is always good to see. And some good questions coming in. So if there's any further questions, please do contact your Davy Select representative, or give myself, Gary, or Rory a shout. We're always here to help and have the chats over the phone at the moment, which is pretty much all we can do. Yeah, thanks to everyone, and hopefully we'll see you all soon. Thanks.
Cheers. Thanks a lot.